My price target for gold is significantly higher over the next 10 years. And so I don't care what it does over the next market cycle. And I can't be certain that if we have another '08 moment, that gold's going to retrace, because 2024 and all the reasons we just discussed, with de-dollarization, with the BRICS, with the BIS, with the tier one status, with the ignored problem with our currencies and the ignored reality of precious metals in the media, that another 208 moment will have the same reaction from gold. Gold will not move in a straight line. Absolutely not. And we've seen, a couple of negative years, 2013, 2015, double-digit falls in gold, and percentage-wise. I'm not going to sit here and promise that gold only goes in a straight line. That'd be nonsense. I honestly don't know what it does by the end of this year.
MatthewPiepenburg, a seasoned financial analyst and commentator known for his insights into global macroeconomics, precious metals, and market trends, emphasizes the unique factors shaping gold's outlook in 2024. Drawing from historical context, Piepenburg notes that while gold dropped around 30% during the 2008 financial crisis, the 2024 environment differs considerably. Fundamental shifts like de-dollarization, currency realignments, and new BRICS initiatives create an unprecedented backdrop, suggesting that any future market downturn may not affect gold as it did in 2008. Gold's recent performance in 2024 has been marked by a decisive breakout above the $2,000 level, signaling what many consider the start of a sustained bull market. The long-term forecast anticipates gold reaching between $8,000 and $10,000 by 2030, driven by the increasing pressures on fiat currencies and shifting economic alliances. In the past decade, gold has spent approximately 80% of the time moving sideways and only 20% rallying. This trend could reverse in the future, with gold spending 80% of its time in rallies and only 20% trending sideways. Gold has surged past $2,800, forming a swing high, a signal that a pullback may be on the horizon. Upcoming events, including the U.S. presidential election and the Federal Reserve's policy decision, will likely influence this trend. While the market appears to have priced in a modest rate cut of 0.25% by the Fed, the election outcome may be a critical factor in the direction of precious metals in the near term. Piepenburg highlights that gold remains historically undervalued when adjusted for inflation and compared to the M2 money supply. This indicates that gold has significant room to grow despite appearing high-priced in nominal terms. Analysts suggest that, in response to ongoing currency and debt challenges, gold could realistically climb to $4,000 or even $5,000 over the next decade, aligning with Piepenburg's forecast of a long-term bullish trend. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It's interesting because it's actually moved faster than even I expected,
Right.
And even Goldman Sachs is targeting gold at 3,000. I can make the pro and con case for gold short term. I mean, there's guys like Henrik Zeberg who said, like in 2008, when the markets crash, and he does see structurally, and I actually see structurally in terms of momentum and volume, that the NASDAQ and the S&P could peak towards the end of the year and then have a real uh-oh moment, or they can be sustained artificially. If we let natural supply and demand and price discovery, these markets are headed for a peak towards the end of the year and a major fall. And if there's a major fall, as in 2008, gold can be very sympathetic and pull back 30%, like it did in '08 for a short period of time. That's one argument. But 2008 is a very different world than 2024. So I can't take that bet that just if the S&P mean reverts, that gold's going to pull back dramatically and I can get a better buy opportunity. I'm an investor. I really don't care longer term because I've got enough gold. But if I were looking to get into gold, I'd say, well, 2,800 is too expensive. Wait for a pullback. Makes sense. Totally get it. And if Zeberg's right, it's going to get cheaper if markets are allowed to fall. And there are, natural price discovery points in that market, which I think Jeremy Grantham and Elliott and these others are right. That's going to happen. Bob Farrell's right, but just don't know when. We could get into the details of what I think the signals would be. But to your point on gold, my price target for gold is significantly higher over the next 10 years. And so I don't care what it does over the next market cycle. And I can't be certain that if we have another '08 moment, that gold's going to retrace, because 2024 and all the reasons we just discussed, with de-dollarization, with the BRICS, with the BIS, with the tier one status, with the ignored problem with our currencies and the ignored reality of precious metals in the media, that another 208 moment will have the same reaction from gold. So, gold will not move in a straight line. Absolutely not. And we've seen, a couple of negative years, 2013, 2015, double-digit falls in gold, and percentage-wise. I'm not going to sit here and promise that gold only goes in a straight line. That'd be nonsense. I honestly don't know what it does by the end of this year. It's higher than I expected. I've seen reports from Beacon Securities, from all these different experts on precious metals. Their price targets go from 1,900 to 5,000. And these are the experts. I just look at the coverage ratio of Web2 like Ronnie Surfula does. I look at the direction of the hockey puck and de-dollarization. And I don't, as even Peter Schiff said, it's not a bull gold market, it's a fiat bear market.
Right.
I don't see any way to save currencies. So if I'm investing for more than the end of the year, it's irrelevant to me because I think gold's easily going to 4 to 5. When I talked to Michelle, it was at 1,600. I said, I think it'll go significally higher, probably 25. Now we're at 27, almost 28. And was I lucky? Not get everything right. I thought they'd cut rates after the financial banking crisis 23. They didn't. And I thought too big. The BTFP was going to be a pivot. Didn't happen. Not always right. But the direction of gold is fairly simple because I see the direction of fiat money because of debt, currencies, precious metals, in an historically significant turning point mathematically now for fiat money, and it's saved the bond market or kill the currency. They're going to kill the currency to save the bond market, not the end of the dollar, just a repriced dollar, which means precious metals have only one secular direction to go over the many years to come. And frankly, when you look at gold compared to the M2 money supply, it's almost as cheap as it was in the early 70s. And when you look at, if you inflation adjust gold would have to go up another 20% just to reach its 1980 all-time highs, inflation adjusted. So people can say gold's expensive. Actually, it's not. It just feels that way. But it's very hard for me to predict. I think it's a mug's game. But longer term, I'll say what I said to Michelle, significantly higher over the many years to come.
Gold remains a prized asset for the world's wealthiest individuals, offering a stable store of value and protection against currency volatility. Recent reports reveal that 21% of ultra-high net worth individuals globally have increased their gold holdings over the last 2 years, reflecting a clear preference for gold's security amid uncertain financial conditions. This trend extends to sovereign funds and central banks, which view gold as vital to their strategic asset portfolios. According to the World Gold Council, central banks globally increased their gold reserves by a net 186 tons in the third quarter of this year. Year to date, central banks have added 694 tons to their reserves, a pace slightly below 2023's record-setting levels but consistent with 2022 trends. Over a 12-month rolling period, central banks have expanded reserves by 909 tons, far above the historical average, a testament to gold's enduring appeal as a safe haven asset. Financial expert MatthewPiepenburg highlights this shift, especially among Eastern countries, noting that these central banks have significantly reduced their holdings of U.S. treasuries while buying gold at record levels. Around 30 countries have even taken the extra step of repatriating their gold from foreign exchanges to store it domestically, preferring the security of physical gold over the leveraged and often volatile paper markets like COMEX and the LBMA. Let's get back to the interview.
In the West, what are they doing except for the Bank of England, but they'll be doing it soon? They're just cutting rates. Everyone's cutting rates. And of course, Japan raised rates to try and help their yen from it, and that created this carry trade disaster, which we saw. But the de-dollarization theme, I've been, from the moment we weaponized the U.S. dollar, Grant Williams, myself, Jim Rickards, a bunch of us were kind of predicted or criticized for being too negative on what the implications of that were because of the patriotic fervor about Ukraine. You have to step outside of the Ukraine debate, which I'm not going to get into, right or wrong, but weaponizing the world reserve currency is something John Maynard Keynes warned against. Barack Obama warned against that in 2015 during the Syrian period. And even Robert Griffin, when he came to our Congress, said, whatever you do, don't weaponize the world reserve currency, because when you do that, other countries lose trust. And I warned that that was as big a shift in 2022 as going up the gold reserve was in September of 1971. And what we're seeing right now in de-dollarization, this is not an exaggeration anymore. We'll get into the Enbridge for a second, but when you're looking at the de-dollarization, you have to look at this from the BRICS perspective, from the East perspective, and what the BIS is doing, what the petrodollar is doing. These are all reactions to the U.S. going one step too far and bullying the world with its world reserve currency and its status. It's been exporting inflation for generations, but this time they jumped the shark, so to speak. And I think, the BIS just made physical gold a tier 1 asset next to the U.S. Treasury, that risk-free return, which I think is return-free risk measured against actual inflation. That's a critical moment when the BIS says that the next best way to store value is with physical gold. That was off the headlines. No one talks about that. Seismic shift. You've got Eastern central banks net dumping U.S. treasuries and buying physical gold at record levels since 2014. No one discusses that. You've got 30 countries repatriating their gold outside of the New York and London exchanges because they want it within their own zip codes, because they don't want it levered with paper contracts and distorted anymore on these exchanges. They want it at home because gold is so much more important now as a tactical and strategic reserve store of value to save with, rather than a U.S. Treasury or U.S. dollar. You've got the COMEX and the LBMA markets exchanges seeing outflows, massive outflows. So they can't lever, even with Basel III regulations, they can't lever the gold price down artificially like they used to just 3 years ago. Unthinkable. So you've also got 45 BRICS nations now openly trading outside of the US dollar. You've got a gold exchange in Shanghai. It's going to reprice fairly gold in a different way than it does in New York and London. So that means that London and New York can't have a 200-day moving average in gold that's different than the one in Shanghai. They can't explain that because now Shanghai is going to do it more fairly. We used to be worried about the Moscow World Standard when I was talking to Michelle a couple of years back, but it's actually Shanghai. And then you've got the IMF talking about central bank digital currency during the COVID crisis, signaling the inevitable CBDC. But even that has to be pegged to gold to have value. You have massive, massive changes in the petrodollar, which now in just the last few weeks have seen huge changes. And we'll talk about that hopefully because it's really, really important for the gold price. But no one is talking about it. And then, of course, you have this M-Bridge new thing that's could possibly be operational. This is not a conspiracy theory, but all of these things signal that the rest of the world, in particular the East, I mean, Poland has more gold now than the UK. Since Gordon Brown sold UK's gold, they have lost 90% of the purchasing power of their currency compared to gold. It was appalling. The countries in the East are playing chess, while the countries in the West are really playing checkers. And so all of these things that I just talked about are open and obvious indicators of a world moving away from Western fiat money in general, in the US dollar and US Treasury in particular, and going to gold. I'm not saying that as a gold bug. Look at the data, look at the moves.
The ongoing gold accumulation by private investors and central banks underscores a growing preference for stability and security amidst global economic uncertainties. This trend suggests that gold is increasingly seen not only as a traditional safe haven asset, but as a strategic hedge against the vulnerabilities of fiat currencies and the potential for financial disruption. As more countries repatriate their gold and reduce exposure to paper assets, it is clear that both private and institutional investors are looking to safeguard their wealth through tangible assets. Given this momentum, gold's long-term outlook appears robust, with the potential for significant price increases if current macroeconomic challenges persist. How might the increasing preference for gold as a safe haven asset impact traditional investment portfolios? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.